Hi, I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. So one stock that we were looking at in our group coaching class, which is our daily trade idea class, was USO, an ETF actually, and it's oil. USO represents ownership in oil in the form of an exchange traded fund. Now, oil right now presents a really interesting opportunity. Brent futures are at their lowest levels since last seen in the past fall of 2016. Oil's really cheap, and consequently the price of the ETF USO is very low. Now, we have to look at how to play this. Now, sometimes when there's a move in either direction, down or up, some people think about, well, maybe I'll play some continuation, or maybe I'll play a breakout to the downside since we're making the move lower. However, in a commodity like oil, that starts to become impractical once it reaches a low enough level. Now, where exactly the floor is, that's somewhat debatable. Different experts will give you different exact levels of how low oil can go. It could still go lower. But in the long run, oil, in my opinion, is very likely to rebound some, and possibly a lot if held long enough. So now, as an option trader, I look at, well, okay, so how do I want to play that thesis? So what I do is I look at implied volatility. That gives me somewhat of an indication as to what types of option strategies would be appropriate for playing any given scenario. Now, oddly, implied volatility is very low right now. That means options are cheap. It's a go-to strategy of mine, and one that I've used in USO on dips in the past, to step in and sell puts and either A, keep the premium if the puts expire, or B, accept assignment and just buy more shares at a lower price. Now, I've done that and I've acquired some shares and I'm holding them for the longer term. But now, I don't like that strategy because options are so cheap. So instead, if you're not already holding shares of the ETF, USO, I like simply buying some in-the-money calls that are close to 100 delta that have little or no extrinsic value to them. For example, the 7 strike. So the trade that I like, and the one that we talked about in our group coaching class, was buying the USO 7 strike calls with about 3 weeks until expiration. Now, the reason why those are so strong is because it can be a very leveraged position. You pay a whole lot less than buying shares of USO, and if we get a rebound, you can enjoy a very high percentage profit. Now, there's practically no extrinsic value, and so you're not really paying any premium over parity. You're buying the offer, so there is the bid-ask spread that you have to contend with, but the bid-ask spread is not very wide in the USO 7 strike calls, and so this makes this a really nice trade. I like it. I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group.